Welcome friends to our channel SNK and Company. This is your weekly update on important developments in income tax law, GST litigation, and corporate regulatory matters. Let us begin with the significant rulings under the Income Tax Act for this week. The Delhi Tribunal in the case of Deputy Commissioner of Income Tax versus Ajay Vision Education, Private Limited, delivered an important ruling on penalty under Section 271(1)(c). In this case, the assessee had disclosed certain unrecorded cash income during reassessment proceedings, and the assessing officer accepted the disclosure without conducting any further inquiry. The tribunal held that when the assessee voluntarily discloses income and such disclosure is accepted as it is, the situation cannot be treated as concealment of income. Therefore, levy of penalty under Section 271(1)(c) could not be justified. The tribunal also observed that where a penalty notice issued under Section 270A does not specify the precise limb of the provision or indicate whether the allegation relates to underreporting or misreporting under Section 270A(2) or 270A(9), such defective notice becomes legally invalid and the penalty cannot survive. Moving to the next ruling, the Chennai Tribunal in Deputy Commissioner of Income Tax versus Triumph International India Private Limited examined the computation of book profits under Section 115JB. The tribunal held that while determining book profit, the assessee is entitled to claim set-off of the lower of cumulative brought forward business loss or unabsorbed depreciation as per books, even if parts of those losses or depreciation were already adjusted in earlier years. This ruling reinforces that the adjustment mechanism under Section 115JB must be applied strictly, as per the books of account and not as per tax records. The Raipur Tribunal delivered two significant rulings. In Anju Parekh versus Income Tax Officer, the tribunal held that where the assessee had sold shares through recognized stock exchanges, paid securities transaction tax, disclosed the transaction in the return, held the shares in a demat account, and routed the payments through banking channels. The addition of sale proceeds as unexplained cash credit merely on the basis of generic penny stock investigation reports was unsustainable. Since no direct nexus was established between the assessee and any alleged manipulative activity, the addition was held to be arbitrary and required deletion. In another matter, Khandawal Industries versus Income Tax Officer, the tribunal held that where a partner introduced capital supported by a proper cash flow statement and bank records, and the assessing officer ignored these documents merely because the partner's income tax return did not show cash in hand, the addition made by the assessing officer violated principles of natural justice. Since the revenue made no enquiry to disprove the explanation, the addition was deleted. In the same decision, the tribunal also held that where the assessee had placed a deposit with a company and the assessing officer first alleged personal use and later shifted arguments claiming diversion of interest-bearing funds without making any actual inquiry, the addition was based purely on assumptions. Consequently, such addition could not be sustained. Another important decision of the Mumbai Tribunal in Hewlett-Packard Financial Services, India, Private Limited, clarified that filing a return of income within the due date under Section 139(1) is not a precondition for carrying forward unabsorbed depreciation. The tribunal held that unabsorbed depreciation, being governed by Section 32(2), can be carried forward irrespective of whether the return is filed within the time prescribed under Section 139(1). We now move to major updates in GST law. The Calcutta High Court examined a case where the petitioner had requested quick disposal of a refund application, and the refund authority rejected the claim after due consideration. When the petitioner challenged the rejection on the ground of jurisdictional error, the court observed that the petitioner had participated fully in the proceedings and accepted the authority's jurisdiction. Since no jurisdictional error existed, there was no justification to invoke writ jurisdiction. The same court also dealt with an important issue relating to pre-deposit. It held that when an adjudication order imposes only interest and penalty with a nil tax demand, and at the time of the appellate order, there was no statutory mandate requiring pre-deposit for such interest-only or penalty-only demands. The appellate authority's dismissal of appeal for non-compliance of pre-deposit requirements was erroneous. The Allahabad High Court delivered a significant ruling regarding filing of GST appeals. The petitioner had deposited the disputed amount, but due to auto-populated figures on the GST portal showing nil demand, the system did not allow the assessee to electronically file an appeal under Section 107. The court held that the right of appeal is statutory in nature and cannot be defeated due to procedural technicalities of the GST portal. Accordingly, the petitioner was permitted to file a physical appeal, which the appellate authority was directed to entertain on merits without raising any objection on limitation. Finally, another decision of the Calcutta High Court addressed the manner of electronic service of notices. The court held that when a show cause notice proposing adverse action was uploaded only under the Additional Notices and Orders tab and not under the main Statutory Communications tab, and because of this, the petitioner could not file a reply and an ex parte order was passed. Such electronic service did not amount to valid communication under law. Since the petitioner was prevented from responding due to a procedural lapse, both the adjudication order and the appellate dismissal were set aside, and the matter was remanded for fresh hearing. Let us now turn to important updates under other corporate and economic laws. Under SAFEMA, the authority in New Delhi held that where an appellant company exported goods but failed to realize export proceeds within the permitted period and also failed to obtain write-off approval from the Reserve Bank of India, the penalty imposed on the company and its directors was justified. However, considering the circumstances, the authority directed that the penalty amount be reduced. In another significant ruling, the Delhi High Court held that compliance with Section 66(2) of the Prevention of Money Laundering Act is not a condition precedent for issuance of a provisional attachment order. The court clarified that any delay or omission in sharing information under Section 66(2) does not invalidate the provisional attachment order or any subsequent proceedings. The Bombay High Court, in a matter concerning allegations of cornering shares of Yes Bank and IDFC during their IPOs, held that the SEBI circular of 20th April 2007, providing guidelines for consent orders and settlement of offenses under securities laws, cannot be interpreted to mean that a consent order or payment of disgorgement or settlement charges would extinguish criminal liability. The court held that the criminal prosecution could continue independently despite the assessee having opted for consent proceedings before SEBI. This concludes this week's important updates in tax law, GST litigation, and corporate regulatory developments. Thank you for joining us on SNK & Co. We will return next week with more updates and analysis.